Welcome to this latest episode of Damien's Market Update. Now, as usual, if you find this useful in any way, if you're on YouTube watching this, then please make sure you hit that like button, but also subscribe to our channel so you get these market updates every month. And if you're listening to this on our podcast feed, then please, if you find it useful or anything that we do at Main to the Masses, then leave us a 5-star review. Now, last month's episode was titled All Possibilities Still on the Table, but who would have thought that that included a banking crisis? Now, in the hours after filming last month's show, inflation, economic growth, they all took a back seat to a banking crisis that came from out of left field. And it meant that equity markets slumped while gold and bonds rallied, but the worst of the equity market losses were felt at the epicenter of the crisis, which was obviously those bank stocks. Now, you pick almost any bank stock in the US, UK or Europe, they were down about 10 to 20% in the days after the banking crisis started, and some fared even worse than that. Now, in episode 409 of the Money to the Masses Sunday podcast, I explained what triggered the failure of Silicon Valley Bank and ultimately the banking crisis. I won't go into detail here. You can listen to that episode yourself. But what we have learned is that history's taught us that central banks, and in particular the US Federal Reserve, have a history of raising interest rates quickly until they eventually break something. So the failure of Silicon Valley Bank was a reminder of that fact, and it was the largest failure in the US of a bank since the financial crisis in 2008. So it was a sign that those rapid rises in interest rates over the last year have indeed begun to break things. So interest rate rises have put pressure on banks' balance sheets, particularly regional US banks, at the same time that savers are moving their money in search of better returns elsewhere with other banks or money market funds. So this has sparked a series of bank runs, which we saw during March, and then the subsequent contagion or the fears of contagion over to the UK and Europe banking sectors, and that resulted in the takeover of Credit Suisse by its rival UBS. Now, as US and European bank stocks tumbled, they dragged down the broader equity market indices, and bonds rallied as recession fears began to resurface. And if you looked at the VIX, which is the market fear gauge, that's what it's also known as, it soared to 30. Now, its long-term average is somewhere nearer 20. And at the same time, the CNN Fear and Greed Index hit extreme fear after signaling that greed was the emotion driving markets just a month before. Now, at the height of the investor panic, most stock market indices had given up all of their month-to-date gains, and they sat on losses of 2% to 6%, with the bank-heavy FTSE 100 being the biggest laggard by the middle of March. Now, eventually, emergency measures by central banks and governments, but that's especially in the US, restored some calm to the beleaguered banking sector. Now, one of the simplest ways, if you want to look at the change in market sentiment towards bank stocks, is to watch the price moves of an ETF known as XLF. You can find that if you just Google it, particularly on Yahoo Finance, or if you search the stock market app on your phone. Now, that index tracks the S&P 500 financial stocks. Now, from a technical analysis point of view, the damage caused during the initial 2 weeks of the banking crisis saw that particular ETF, so that's the XLF, fall to a critical level, and that support line that it hit was 31. Now, it's no coincidence that it hit that with a daily close of 31.01 before it eventually rebounded, and it's because that support line is important. It was a strong resistance line when the index peaked ahead of the COVID crash, and if you zoom out even further, it was true as a resistance line back as far as the financial crisis. Now, you don't have to understand the technical analysis part, but all you need to know is if you look at the XLF chart, if it's below 31, it's not good news. It's bad news for banking stocks, not just in the US, but also by association in the UK and Europe and wider stock markets. At the moment, it sits at 32.88. But that's still a far cry from the level of 36, which was the level it was sitting at just before the banking crisis erupted. Now, it means there remains caution over the health of the banking sector, even if there is a sense of calm that's been restored and the headline equity market indices, if you look at them, have recovered. Now, that's with the exception of the FTSE 100, which is just shy of its early March levels, only just. By the way, if you want an index to watch that reflects the sentiment towards European banks, then have a look at the Stocks Europe 600 Banks Index. So while there is now a sense that the banking crisis may be behind us, if you look at the VIX that I mentioned earlier, that's now tumbled back down to 17. And the idea that a full-scale financial crisis has been averted, the one thing I would say is if March has taught us anything, it's that all possibilities still remain on the table, as last month's title suggested. Now, during the worst of the banking crisis, the best performing sector was, in fact, index-linked gilts, and that shouldn't come as a surprise, as markets began pricing in that central banks would likely slow or cease their interest rate rises, or, well, possibly even cut interest rates by the end of this year. It meant that bond funds with long durations rallied strongly, and index-linked gilts tend to have long duration. Now, don't forget that duration is a measure of sensitivity to interest rate moves. So when we're talking about bonds, for every 1% increase or decrease in interest rates, a bond's price will change by roughly 1% in the opposite direction for every year of duration that the fund or bond has. So if you're talking about a bond that has a duration of 5 years, then if interest rate rises 1%, the bond price will fall 5%. Now, bond funds own hundreds of bonds, which, when combined, give the fund an overall duration which fund managers will look to control. During 2022, funds with longer duration fared the worst as central banks raised interest rates aggressively and markets priced in further rate hikes. And that's why gilt funds did so badly in 2022, but did so well in March this year. Now, if we look at the equity space, technology funds can be described as being long duration. The price of technology stocks is influenced by the potential size of earnings and profits that will be realized in the future. Now, don't forget, technology companies are often loss-making in the early years of existence, and it means that share prices are really a function of discounting or repricing future earnings back to today. So if future earnings are predicted to be higher, or more importantly, if interest rates drop, it means that the present value of those future earnings will be greater, which therefore pushes up the company's share price today. That is why technology stocks were the second best performing equity sector in March when the banking crisis unfolded. Now, moving into April, it's been very different to March, with equity markets struggling for direction as investor sentiment has changed almost on a daily basis, influenced by the latest economic forecasts and analyst predictions of the future path of monetary policy. It means that investors have flip-flopped from one asset or equity sector to the next, trying to buy into the latest narrative, and so are in danger of chasing their own tails. Now, one day, renewed recession fears dictate market moves, only to be replaced by hawkish or dovish interpretations of central bank policy or statements from members of those central banks. Then the next day, we seem to get inflation concerns preoccupying investors' minds. And so we just result in assets rallying and falling back in quick succession, but largely going nowhere. But there are some trends that are worth watching in the coming weeks. Firstly, the US dollar index has broken down and hovers just below 102. If it breaks lower, it could prove a tailwind for US equities and gold. Gold has rallied more than 10% since the banking crisis started on the 8th of March. Many people haven't realised that. Also, the falling dollar has meant the pound has soared more than 5% in a little over a month. But it may surprise many to hear that European equities, as measured by the Stocks Europe 600 index, are up over 23% in the last 6 months when taking into account currency moves. Now, this is in stark contrast with the S&P 500, which is up just over 2% when you factor in the strengthening of the pound versus the dollar. It may also surprise some to hear that the French CAC 40 set a new all-time high in recent days as European stocks continue to benefit from China's economic reopening post-COVID, as well as the influx of investors tempted by attractive stock market valuations. So to sum up, the events of the last month mean that investors are finally starting to take notice of assets that have been unloved over the last year, which includes gilts, bonds, gold, technology stocks, and European stocks. It'll be interesting to see what happens in the coming weeks and months. And one final thing just to point out before I finish the show is that company earnings are now being announced in the next couple of weeks, and that could influence what happens in stock markets as well. So that is it for this episode of Damien's Market Update. As ever, if you've enjoyed the show, found it useful, please hit that like button on YouTube and subscribe to our channel. But if you're listening to this on the podcast stream, then please make sure you give us a 5-star review.